let's say you have a business, right? How do you pay yourself as a business owner? How do you actually take care of things while complying with the laws in every state or even federally? Let's talk about that. Let me give you the overview here. How do you pay yourself as a business owner? Depends on your situation, depends on the sector you're in, and it depends on the business structure, the stage of growth of your business, and other factors. Okay. So while paying yourself may not be the first thing that comes to mind as you are building a business, knowing the factors to consider and using the correct payment method can set you up for success as the business grows. Because we're talking about scalability, you have to make sure that scalability fits with regulatory compliance, but also your own financial situation. Now let's talk a little further here. Now there are two primary ways to pay yourself. You have salary and then you have owner's draw. Now let's talk about that. Now salary, you actually pay yourself a regular salary just as you would an employee of the company, withholding taxes from your paycheck. This is legally required for businesses that are structured as S corporations or C corporations or a limited liability company taxed as a corporation. The IRS has something called a reasonable compensation requirement, which means what? Your salary should be comparable with what someone else is actually earns if that person is doing the same job in your industry. Very important. The IRS sort of monitors this criterion very, very closely. Okay, so your salary has to be reasonable. Don't give the IRS the idea that you are underpaying yourself. So salary is the first option for you to pay yourself. The second option here is owner's draw. So owner's draw basically means what? It means that you draw money in cash or in kind from the profits of your business on an as needed basis. Okay, and you can draw up to the amount you put into the company, which is known as owner's equity. And you don't have to pay taxes up front every time you take a draw, but it is actually wise to set aside money regularly to budget for your tax bill. Okay, so when we talk about the owner's equity, there's actually a financial statement that actually documents all the transactions revolving around owner's equity. It's called the statement of owner's equity, and in some companies called the shareholders equity statement. Okay, that's where you have things like retained earnings, you have things like additional paid-in capital or initial capital, those sort of things. Also, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. I want to quickly talk to you about the pros and cons of each method. Okay, I want to really go a little deeper in terms of comparing and contrasting those two methods. So when we talk about salary, I want to first talk to you about the pros. You have this option is stable. It's actually a recurring expense to budget into your business cost. So you know that, hey, listen, every month or every 2 weeks, I'm paying myself $3,000. Okay, so which means that on a monthly basis, I'm paying myself $6,000. So it is stable, and you have a clear idea what you really have, what you really expect. And taxes are deducted upfront, so you don't have to really worry about quarterly tax filings, all that kind of stuff. No, you know that the IRS has been paid, state tax authorities have been paid. So those are the two main pros if you go to the salary option. What about the con? Well, basically, this is not flexible because your salary has to follow the reasonable compensation rule even when business is bad. Okay, so which means what? Which means that you have to really make sure that you do not fall on the wrong side of the equation when the IRS starts monitoring your transaction. Okay, so if your business is not generating enough revenue, you still need to pay yourself reasonable compensation. Is it a good idea? Not really. But hey, listen, it is what it is. And so that's for the salary. Now let's talk about the owner's draw. The pro that we've seen in this strategy here is that you have flexibility because your draw can depend on business performance, right? So you are sinking your draw, the amount you're drawing from whatever revenue, whatever cash inflows you are actually generating within the business. What about the disadvantage of the owner's draw? Well, you need to budget for a tax bill at the end of the year. Because again, owner's draw means income to you. So you need to pay something extra to the IRS because you're not deducting taxes while you're drawing. The thing I want to say here is that, overall, there are other methods of taking money from your business, such as dividends and distributions. So whether and how you can use these methods depends on the structure of your business And an accountant can advise you on the pros and cons of each, or you can let us know in the comment section. One of our team members will get back to you based on your situation. Boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay yourself first in business. Now let's talk about how do you decide? Like basically, you're just sitting right there. You're thinking, okay, I want to pay myself, but how do I actually decide how to pay myself and how much to pay myself? So there are a few factors that will determine how you pay yourself. First of all, your business structure. So your specific business structure, whether we're talking about a sole proprietorship, a partnership, a limited liability company, an S corporation, or a C corporation, dictates when and whether you can take a salary and or an owner's draw, because the situations are totally different. And if you were to put in state tax regulations, things could become a little complicated. Okay, so typically you can take an owner's draw if you have a sole proprietorship, partnership, or an LLC, and you can take a salary when your business is a corporation or an LLC taxed as a corporation. So when we talk about corporation, we're talking about S corporation and C corporation. Okay. So again, an accountant here, a CPA, can walk you through the requirements and tax advantages of your business structure. Or if you would like, please let us know in the comment section what your situation is, what your question is, and one of our team members will get back to you. Now, it's really important to understand the different business structures. Okay, so when it comes to paying yourself, one factor to consider is how your business was set up in the first place. If you're wondering now, how does the business owner pay themselves? A few of the most common ways are sole proprietorship. With a sole proprietorship, there's no distinction between business and personal assets, expenses, or taxes. So while they're easy to set up, requiring minimal paperwork or approvals, there is little protection or tax benefits. Then you have the limited liability company. So while laws vary state by state, an LLC typically provides the most flexibility around corporate structure, tax payments, and legal liability. It also works to protect your personal assets in case your business fails or suffers losses in the future. Okay, and now you have C corporations and S corporations. Now these are tax classifications which impact whether the company is taxed separately from its ownership or if income and losses are passed through shareholders. And your LLC can technically be taxed as a corporation without being registered as a legal corporation. So in other words, you have to actually elect to be taxed as an S corporation. Either way, you need to speak with a tax and business professional when deciding how to set up your business and which tax classification you should use. So the first factor is the business structure. The second factor is the business stage. Many entrepreneurs don't take any money in the early stages of their business, but as soon as your business is on firmer footing, or you have a good sense of cash flow, start thinking about paying yourself so that you can factor that amount into the business's operating expenses. Another factor you want to really think about here is personal finances. Okay, the payment amount and method you should use, it really has to do with your personal finances. And I'm talking about that payment should cover all your personal obligations, such as a mortgage, car loan, and basic expenses. If you have a family, you got to think about your children and spouse. So if your finances are not really strong, or you're not paying yourself at all, that may put you at a disadvantage when seeking small business financing. So you got to really think about how much should you pay yourself? It really depends on a lot of things. Once you decide how to pay yourself, you need to pick an amount. Now, based on our research, the average entrepreneur makes about $68,000 to $75,000 a year, based on self-reported salaries at PayScale, and also Glassdoor. And if you're taking an owner's draw, your pay should come from the business's net profit, which is revenue minus all operation expenses. So that ensures that you meet all business obligations, including paying employees if you have them, before paying yourself. And so one rule of thumb based on our research here is that you got to pay yourself a fixed percentage of the business's profit so that your compensation can adjust according to the performance of your business. This is important because in good times, you can really enjoy the bump in salary, and bad times you have to feel also the pinch of the drop. This is very important. Now, there are some mistakes that you need to avoid while paying yourself. Do not mix personal and business finances. Okay, this is basically the primary tenet of business. Always keep your personal and business accounts separate. So using a business credit card to pay for your personal expenses or not actually transferring your pay or owner's draw from your business account to a personal account can lead to accounting complications and hurt your chances of getting a small business loan. Another mistake that we see a lot is not budgeting for taxes. So if you are using the owner's draw method, you should keep a part of every draw aside for taxes since they're not deducted upfront. As a business owner, you always have to pay taxes on a quarterly basis, and accounting software can typically help with that. So if you do not budget for it, you risk being hit with a big tax bill. You may not have the cash on hand to pay. And another mistake is never paying yourself or being inconsistent about it. So you may not pay yourself in the beginning, but ideally, your compensation should be part of your business plan. Your financial projections should include the amount of your salary or owner's draw to help you understand what your business needs to grow. Very important, okay? And boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay yourself first in business. So when we talk about paying yourself from your business, and I've already established that, yes, you have the owner's draw and you have the salary. But the thing here is that you have to understand that situation may change. Basically, there could be some years or some quarters where you think that the owner's draw is better, and there could be other seasons where the salary is better. Now, how do you decide? Well, as I have established before, when you start, it's always better to go with an owner's draw because the company is not generating enough revenue. So you want to base everything around performance, right? But while you're doing this, you have to analyze the industry. You have to analyze the consumer trends. You need to analyze the revenue trends. You need to understand cash inflows and cash outflows. Okay, it's one of those things where if you were to go again, when you think about salary, the salary option is more stable. The salary option gives more transparency. The authorities such as the IRS and state tax authorities, they love it when you have a salary because it just injects a level of transparency into your accounting. But salary means that you are stable. Salary means that you have been in business for a while and you have a clear idea about the cash inflows and the cash outflows surrounding your business. Owner's draw is more I wouldn't say sporadic, it's more strategic. So basically, you are timing the draw with the performance of the business. Now, the owner's draw is great for you, but bad for not bad, but it's like authorities don't look at it like with a good eye. Even investors also, because not only do you not pay yourself tax, like do you not pay taxes when you draw, because the authorities will want to be paid too. I mean, they want to be paid when you pay yourself. So, and if you have a salary, you take care of that. But when you're having a draw, you have to pay them on a quarterly basis or at the end of the year. If you do not, you will be slapped with fees and penalties and what have you. So the bottom line is you need to really understand that owner's draw or salary, it has to be a timing thing. You can decide with either. You can decide on either or depending on the timing of the cash outflow. But ideally, you want to make sure that you time everything. You time everything with stability. Stability means what? Stability means you have a clear idea what's coming in and what's going out of the business, so that you're never surprised about anything. Okay, that's very important. Now, let me give you a pick here. How much should you pay yourself as a business owner? I mean, I've actually answered that question a little bit before, but now I want to dig a little deeper. I gave you numbers. Like I said, 68,000 to 75,000. That's the average in the country. But you probably listen to me right now. You probably live in a country, in a part of the country that's a little different. I mean, where the cost of living is a little different, either higher or lower, right? So how do you actually pay yourself in that situation? Well, the thing is that you got to really consider three things. To pay yourself as a business owner, you got to consider three things, and only three things. This trifecta is the cornerstone of your financial strategy. First of all, you got to consider your finances, your personal finances. Okay, I'm talking about basically, do you have a family? Do you have children? Do you have a spouse? I mean, what is your lifestyle? What is your cost of living? Where you are at? Where you're currently living? You got to really have a clear understanding of that. So you got to consider your personal finances and what is your net worth? What are your assets? What are your liabilities currently? I'm talking about currently. What is your FICO score? What is your credit score? Those elements really are important because they will actually paint a picture, either a rosy picture or I would say, a not so rosy picture, financially speaking. So you have to consider your finances. Number two, you need to review tax implications. We're talking about what? We're talking about paying taxes on a quarterly basis. And when you draw versus when you take a salary, you have to consider the self-employment tax. Is this something you want to really do? Is this something that, because see, it's not really complicated, but it requires an additional level of monitoring, an additional level of regulatory compliance and fiscal compliance. Can you do that? If not, just take a salary. So you got to review tax implications, and based on your tax brackets, it might be better for you to pay taxes up front, or instead of paying it later on. But it has to. Everything depends on your situation. And the third thing you want to look at, I spoke to you about trifecta. The third thing here is you want to pay attention to your business's expenses. Right now, are you a startup? Are you an established business? Are you somewhere in between? So it really depends here. So when you analyze your income statement, your P&L, your revenue, and your expenses, pay attention to the level we're talking about. So we're talking about cash inflows versus cash outflows. What level are we talking about here? So that will dictate how much you actually can pay yourself. Because if you have a business where the operational expenses are lower, then you have a little bit of margin when it comes to taking money out of the company. But if you have a business where expenses are still high, that leaves you little room for financial maneuvering, especially when it comes to your own payment strategy. Let me give you a few pro tips before we close to this conversation. I really want you to consider a few payroll factors when paying yourself, okay? And let's talk about those payroll factors. So the type of business structure you have will also play a role in the answer to how do I pay myself for my business. As a sole proprietor, an owner's draw is your only option, as I said before, for paying yourself because there's no distinction whatsoever from a tax perspective between personal and business. That's pretty clear. Okay, business expenses, of course. If your business is an LLC, so limited liability company, and you don't have any other employees, you also need to use an owner's draw in order to pay yourself from your business. As corporations allow you to easily pay yourself to pay yourself a regular salary, as long as it is reasonable, according to the IRS. I've spoken about the reasonable part earlier. So while it may be appealing to be especially generous with your salary, knowing that the more money you take out of your business, especially early on, the less you will have available as you grow and expand. So just like your business is always changing, how much you want to pay yourself may also actually be in regular flux. So that's really important. It's one of those things where you can actually reach out to a third party, to a payroll company, to sort of help you figure out how to structure things. And you want to structure things the right way, because otherwise you will be having problems. Okay, and so there are some common mistakes that you really want to avoid, like the tax implications. It's important. You may inadvertently end up with a higher tax liability depending on your personal situation and corporate structure. You want to focus also on keeping personal and business finances separate. I've said this before, and the best way to do this is to have actually separate bank accounts and also separate credit cards. So you can have a business credit card where you charge all the expenses. You can have a business account where you basically get money in and money out, so cash inflows and cash outflows. And so those accounts will be different from your personal account, personal checking accounts, and personal credit cards. And you want to have that, okay? You want to have that because basically you do not want to actually have a problem with the IRS. They start questioning you, they start auditing you because they realize that there's something fishy going on with your taxes. Thank you so much for your attention. I really appreciate it. Into this conversation, let's do a quick recap here. I spoke to you about how to pay yourself first in business. So I give you the overview, and I give you the pick, the pro tips, and then now the recap. I hope you found this valuable. God bless you. I'll see you next time. Until then, remember, stay marvelous.